Hello. Good evening, everyone. Hope you're well. Thank you for joining this webinar on foreign exchange in a series of educational webinars that we are doing under this series of webinars. I repeat, I hope you've all been connected okay. I remind you the group is free, so you don't have to request to accept. You can just follow the link. Maybe you have friends asking whether they need to do so, but we've opened the group so everything can watch it, and maybe you can help friends perhaps that might have a question around it. So, my name is Ioannis Kantartzis. You can see at the back. I'm an external collaborator for the foreign exchange webinars that we will be doing, and I'm the editor-in-chief and partner at Traders Magazine, which we only produce in Spanish, Greek, Italian, and German. So hopefully you do speak one of these languages. We don't have an English language. Spanish and Greek websites are free. And you can also find some information about me in my website at ikantartzis.com. You can find my CV and all the stuff that I do and further educational help, I would say. I'm an options guy. I trade options and futures, and I have been doing that on the foreign exchange market for the past 10 years. And along my career, I've been with an online global leader in CFDs, so contracts for difference, so online leveraged products, which we will see today. And then moved on to work for Citibank, and hopefully we can share some of this experience today in how really the foreign exchange market works. And the purpose of this webinar and the ones that will come are to give you an introduction, a very fair introduction of what this market is all about, and hopefully to be able, after you've watched it, to avoid the glitches and the cliche that people use. For example, that this market is easy and that you can make loads of money in 5 minutes. So we will try to structure a really professional approach, which, in my point of view, is what you should have in mind. Again, my name is Ioannis Kantartzis, and we'll move forward to the necessary disclaimer. So this webinar is being presented solely for educational purposes, and under no circumstances should it be construed or considered as an investment advice or as a buy/sell recommendation. Okay? Any problems, anything you need to ask, you can do so during the webinar or after the webinar. I always take a look at it and answer your comments, so please feel free to do so. Okay? Now, this is a foreign exchange webinar. I normally started with the notion of money and how we got from where we were in history to where we are today. So the foreign exchange business is an old one, right? It's not a new one. The new part of it is the fact that we can actually, as individuals, can interact very, very easily online from the comfort of our house and enjoy the same prices that the big institutions have. We're going to see all of this today, but before we start, as I said, is a good timing to see what the dollar has done over the years, how we have gone into a digital economy era, because this also performs as a foreign exchange, right? You can see the Bitcoin or other cryptocurrencies quoting against the dollar. So this is a foreign exchange asset class, and I think it's useful. What I have in the back, we will discuss later, but obviously is what we call fiat money, and we will see how good is fiat money these days. So some words on this blockchain technology that I believe all of us, and some of you even more, have been into this for quite a few years. It's here to stay in our lives. We all presume that the future will be shaped based on digital economy. We don't know the form or shape that it will take exactly, but we all feel pretty much that this is really the game changer, right? And the the cryptocurrency or the blockchain technology on the back of it is something that we all need to understand. And in simple words, I have seen from my experience and presentations that I've done, that the best way to describe it is as a Sudoku game. We will see that in a few minutes. But before that, may I tell you that the blockchain technology is really based on a game theory. Right? The game theory, in its own essence, what it stands for is that all participants will actually have no incentive to cheat one to another or one on another. So if I start to mine any currency, then I realize that by doing so, I spent a lot of electricity, which I pay, by the way, with fiat money, right, or real money. I don't know for how long this would be real money, but at the moment that's the situation. And so spending electricity, I actually put myself into working very, very hard to produce what is being called as a process the mining, and as a result get awarded the X cryptocurrency, right? And during this process, if I start cheating, then someone else will start cheating, and then the whole thing will collapse, and it will no longer be based on a trust. And that's why game theory helps understand and depict the relationship between all the players within the mining process. So the game theory is really a theory that leads to what we economists call as a perfect market assumption or theory. That because everyone strives to provide his or her best in terms of the mining process and producing proceeds, they face costs, maybe 90% of what this guy or lady will try to make will go towards the electricity that is being used to produce these coins. And so it's in no one's interest that the risk will be too big. And so everyone is trying to achieve the best. So really good competition, right? Really healthy competition drives people to think more. And by thinking more, they develop better strategies and better ideas, and maybe solve cryptographic problems faster. And then all of this, the better it gets as a community in solving the issues, then the better the whole blockchain idea is getting, right? So I hope you're grasping the notion that this is not just some idea of someone's going against the bad banks and the whole manipulative system that we are going through with this fractional reserve banking that we will see in a bit what it means. But it's also a new idea that will have, and I have no doubt, it will have a lot of applications in other forms of technologies. Not only on currencies, right? But in other forms of technologies, and we already seen these coming through. So this is fantastic news for the whole industry, and it has started from the currency, from the foreign exchange, which is why we're taking a look at it tomorrow as well. So, as I said, the blockchain technology being based on a game theory and creating in its own essence, right, probably for the first time in history, a perfect market status that we have seen, that alone makes it very, very interesting, and people actually delve into more and more and try to give their best in producing these cryptocurrencies. Now, the best way I think about the process, and the best way I've seen around people talking about it, is to simulate it to a Sudoku game, right? You all know what a Sudoku is, I presume. So a Sudoku has some lines and some columns which you are called to solve every time you try to fit in all the numbers in a special or in a little block, right? And imagine that I sit here and I hold the Sudoku, and there's a group of people down there, and I'm saying like, guys, I have a Sudoku here, and I will give $100 to anyone who will first solve the Sudoku, which is 5 by 5. A very clever guy starts working. Within 2 minutes, boom, he solves the Sudoku. He says, Sudoku. And so I give him the $100. And then I make it more difficult right? So I add another 3 columns maybe and another 3 rows. And then I say again, here's another $100 for someone or anyone who solves that. Now, this is the key here. The mining process, or this process, is an asymmetric algorithm. And what that means is that it's infinitely easier to verify than to actually solve it. So the degree of difficulty in solving a Sudoku or solving the cryptographic math that is behind the mining process, right, is exponentially increasing at a rate much faster than the rate I need to actually solve, to actually verify the Sudoku that you are solving. So the 3 rows and 3 columns that I've added make you, instead of 5 minutes, work for maybe 20 minutes, right? And then you come and say, Sudoku, and I pay you the $100. For me to verify it, it will only take maybe, 50 seconds. You see if all the numbers fit in, right? The first one might have taken me like 10, 20 seconds, and this one has taken me 50. And then, to cut a long story short, this increases in difficulty, and at the end we keep adding columns. We're reaching like 100 columns and 100 rows. Obviously, this is very difficult, time-consuming, and then it's a lot of brain work for someone to solve it, let alone solve it on its own. So what he does is he's calling some of his friends, some of these geniuses from these high-class universities, and they form a group, a pool, right? And in forming a pool, they try to solve this cryptographic problem. And so now it takes them like 3 days to solve it, right? It's not easy to solve 100 by 100 Sudoku. And they finally got it. They say Sudoku, I pay them after verifying. But verifying, this is where the asymmetric type of it comes in. It will take me not 3 days. It will take me maybe 3 hours, right? So the idea is that this grows asymmetrically and exponentially in terms of difficulty, but not in terms of verifying. And that's the beauty of it, and that's how you should actually have in mind, in my opinion, the whole process of the mining. So this is called a distributed ledger, like blockchain is a distributed ledger, and that means block is obviously the pool of people who actually, or is like the catalog, right? It's like a file where all cryptographic transactions have been recorded, okay? And they form a block. And then too many blocks together, they form a chain, hence the blockchain, right? And this, in terms of verification, for example, for Bitcoin and for most other currencies, it takes every 10 minutes. So every 10 minutes, all transactions are being verified, recorded. They are unique, right? And so you can't alter the information in there. And it's distributed because everyone can see it, and it's a ledger because this is where they are actually being recorded. And by everyone can see, remember how we were using the PDF files or the Word files like 10 years ago? I was writing something on a Word file, and then I would either have to use these show corrections, and I will send it, save it on my desktop, attach it on an email, send it to my colleague, and then please take a look at it. Your colleague opens it up, takes a look at it, goes through it, and then sees your comments. And underneath your comments adds another window in a different color and puts his comments. And then he clicks save, he saves it on desktop, opens an email, saves an attachment, sends it to you. Isn't that cumbersome? So what it is now with Google Docs, you just pop up and bring a Word doc or an Excel document which is publicly viewed among the people you've actually given the authorization to view it. And so when you make a change, they see it directly. So that's the distributed ledger thingy, equivalent to a Google Word doc where all the changes you do, they're actually reflected straight away. Obviously, there have been some changes, some difficulties in terms of, whether it is fast enough, more and more people go in, whether it is reliable, there is a huge volatility, but nonetheless, this is actually a product that is being quoted against the US dollar and attracts people's interest because it's a speculative instrument. And apart from the fact that it promises to change the world and people to use digital currencies instead of the fiat money. It also serves as an investment vehicle for highly speculative portfolios. And we should say that this is a highly speculative investment vehicle, right? So this is the overview of what we are living in the past 7-8 years when Mr. What was his name? Satoshi Nakamoto, or it's not his real name, I presume, in 2009, presented us a new era of digital payments, and I think we have caught up quite fast and quite a lot since then. Now, interestingly enough, this follows, obviously, the deterioration of the confidence we show in what we call today money, right? I've got a graph here to show you. Excuse me, this seems like we're a little bit constipated. So, I hope you can see this graph on the back, right? And it is the evolution of the dollar. It's in Spanish because I couldn't change the picture, but you get the idea simply because it shows the dollar's movement, or where it was heading in the past 150 years. So since it was created and in 1870, and then the gray columns that you see there represent the recessions throughout the history. And you can see that in 1920s, the creation of the Federal Reserve banking took place, and ever since, I think we haven't seen, I think it's documented here, right? That we haven't seen any rebound on the dollar's value. So the world's biggest currency, the one that everyone thinks is actually the strongest, has lost 95% of its value in the past 140 years. And what helped that happen is obviously the abandoning of the gold standard. But before that, something after the Second World War happened. Right? So we need to understand what this, the money is. And in 1943, in a village called Bretton Woods, or a town, and the big guys of the time, they met up. And they said, listen, we are devastated from the Second World War that has crippled the economy across Europe and in general, and so we need to do something about it. So ever since, they said every dollar in circulation will be backed by the equivalent amount of gold held in the vaults. That will guarantee, obviously, that the currency will not be allowed to have inflationary pressures. Correct? So it was backed by gold, and at the same time, the fantastic agency that is called IMF, the International Monetary Fund, was created supposedly to help nations that couldn't make it on their own. Whether they helped or not, that's a different webinar's topic, I think. And ever since, for about 30 years or 28 years, everything was good, the economy was booming. But then little by little, they came up to distracting the Bretton Woods Agreement, as we call it. And in 1972, with about 9 years of inflation preceding an oil crisis and abandoning of the Bretton Woods, so from the since 1972 onwards, we didn't have a dollar being backed by gold. And what that happened, that coincided, or actually meant, that we went to a fractional banking system, a fractional reserve banking system. What that means? Well, banks were allowed to print money. Just as they do today with the quantitative easing, banks were allowed to print money. And little by little they started doing so, and what had happened is that suddenly the dollar was actually 80 cents worth after 10 years, not $1. It wasn't all of it backed by gold, maybe 70%. And then slowly it started to be inflationary. You would remember maybe that within those 8 years between 1973 and 1981, we had a very big inflationary push, and that we can actually see how people prefer to hedge, right, to protect their exposure in what was eroding their portfolios by investing in gold, an asset that is traditionally anti-inflationary. Right? And so you can see, if you take a look at the historical graphs, that gold had surged at that time by 1,573%. Now, 1,573%, but with the difference that it had a drawdown, as we call it, of only 73%. 47, I'm sorry. Right? So it went up, and this is gold, right? 1,573%, and the risk of it going down was only 47, maybe 1 to 25. So a fantastic market to be directional in one currency. The same time, the S&P 500, right, went up by about 200%, but with exactly the same drawdown. So relationship almost 1 to 4. So one was 1 to 25, and this was 1 to 4. So clearly it would have been a time where you should have been investing in gold. And gold is a currency. It's a commodity, but it trades as a currency. The symbol of gold is XAU-USD. How many gold or ounces of gold can I buy financing my purchase with dollars? That's what it means. So it trades as a currency. Obviously, it's a commodity. You can actually buy it physically. You can store it. It will be a little bit expensive, but you can store it. And the idea is that it does behave as a currency. And the thing, why it is a currency? Because it has one product translated into the purchase of another. You don't just buy gold. You buy gold against dollars. And if you live in Europe, you have to take into account the euro against dollar foreign exchange risk. We will hopefully have some time to take a look at it. But the idea is that since 1972, the abolition of the Bretton Woods Agreement made that banks started to print money, the introduction of fractional reserve banking, and that happened that the dollar was not backed 100% by gold, and so we had a surge in inflation. And since then, 30 years fast forward, and what we have seen is an unprecedented move in history of finance, because for about 10 years, all central banks in the world have actually maintained their core interest rates at 0 or below 0, artificially doing so by means of quantitative easing, and that hasn't happened in any other part of history, at least from what we know. So if that is not manipulation, then what is it, right? Because you do have a central bank by printing money and controlling how much money your money is worth. So this has led to the deterioration of the dollar value that we still see at the back, right? Because you can't print money and expect your money to be worth the same. In fact, some interesting statistics, and why investing is really a great way for your wealth to be placed somewhere, right? Somewhere invested. Because some people say, no, I'm not this type of guy, I can't take risk, I prefer my money in the bank. Yeah, when the bank pays 7-8% interest, it's fine. Well, when banks pay 0 interest, or sometimes you actually pay them to keep your money safe, then that doesn't work. And I'll tell you why it doesn't work. If, say, you live in a country and there are many, many people watching us tonight from across the globe, but say we have an inflation of 3%, right? An average inflation in Europe. If you produce for your money only 50% of that 3%. So if you can produce earnings or return of 1.5%, right? So half of it, in 7 years, inflation will have eaten out 7.7% of your money. So in 7 years, you will be losing about 10% of your purchasing power if you have invested and performed somehow well, but not close to the inflation. So imagine what happens if you don't invest at all, if that is zero. And if you go on and wait another 15 years with being invested but underperforming the inflation rate, your money will be losing 15%. And ultimately, after 25 years, which is a normal cycle of life, your money would have lost nearly 20% of its value. So if you have $100,000 today and you invest them and you earn 1.5% when the inflation is 3%, within 25 years, this will leave you with just $80,000, right? And the figures are average, but that's for you to get an idea how interesting and definite is for you to consider investing your money. And one of these interesting markets is actually the foreign exchange, because there are very, very big advantages in doing so, and it's a really liquid market, and I have got for you quite a big list of advantages that goes to complement investment in other asset classes. Okay, so your money is really worth when you actually put them to work. So we've come from an era of the fiat, the paper money. We've seen that their role of their usefulness is being questioned. We've come into the digital economy, and the changes we have seen in the past 100 years, we will actually be seeing them in the next 10 years. So the number of years that it has taken us to come from an event from past century until today, it will take us only 2, 3, or 5 years, because technology is going so fast, and we can't really realize what is going on every single day, right? So the key to all this is obviously education, isn't it? Because the problem with the stock exchange is that you've got a lot of people that will tell you, listen, I made money, I bought very low, and I sold very high, and I'm very good at it, and either you can give me your money, or actually I will tell you what I do and you can follow me. But it doesn't work like that. If you cannot master your own fate, then putting it into other people's hands, yes, fantastic, you can do that, obviously, but you need to understand what they're doing. You need to understand if they call you and tell you, listen, we're going to buy gold, right? And you know it's an inflationary hedge, and you know how to trade gold, and you know maybe an alternative of why gold. You know how to clear it up in your mind whether you are in an inflationary period or a deflationary period, whether the rates are here to stay low, or maybe we have an increase cycle, right, or a cycle of increasing rates in some countries like the US that has started, and all of these drills down to investment decisions. Now, I'm not saying that every one of you would be able to make it on his own or her own, but definitely you would actually give it to a professional to help you, but at least you have to understand, you have to take your faith into your hands. And what we are here to discuss today is actually how you can do that using the foreign exchange from the comfort of your home, with a laptop and a connection to the internet, right? And with very good knowledge. Because without knowledge, you can't really expect to do many things. And one quote that a very famous person, Estelle Lauder from the cosmetic industry, has said is really depicting this idea of education. Is, she said, when two people, one with experience and one with money, meet, the guy with the experience goes away with the money, and the guy with the money goes away with the experience. You don't want to be the guy who loses money for experience, right? You have to actually invest in yourself. And this is all about education. I've been more than 20 years in this market. I still go to seminars. I still read books. I still listen to other people. I still attend many, many workshops because we learn every day, right? So if you are going into this world and stepping in essentially the foreign exchange, you definitely have to have an understanding of how the whole thing works. Within the 2 hours today and the introduction we've made, we're hopefully giving some good, kick-off start with this, but then there is a lot of things that should come with it. Because you've got the foreign exchange, you've got the derivatives business, you've got stocks, you've got to understand the economy cycles, but hey, before we learn to fly, we have to start walking. Okay, so here we are today. We will be starting to walk, and we will go through some psychological or behavioral traits, as we call it, and help you understand what to avoid. Because I'll tell you what, today's webinar is not about telling you how easy this market it is. It's about telling you how easy it is not. How easy it is not. Because I don't want you to fall into this global rule, right, that all novice traders fall. And that is the 90-90-90 rule. What does it mean? That 90% of new clients lose 90% of their money in just 90 days. Do you want to be in these meager statistics? No, you don't. The way not to be is actually knowing what other people's mistakes are, right? And then try to master them. Because going with ignorance, or even worse, with a sense of superiority that actually you will beat everyone in there, and this is a fantastic product that I can master in 2 days, that will actually make you a small fish that will be eaten by the sharks. That, this sea, the market sea, is infested with big white sharks. Okay, always bear that in mind. They are waiting for you to eat you alive. And the way to avoid that is actually to understand the risks of going into a sea. But if you happen to understand how these big sharks work and think, you will be in the 5% of all investors that actually are successful on a long-term basis in this business. And remember, when you go into a poker table and you sit and try to find and haven't realized within 2 seconds who is the sucker, trust me, it is you. So let's see how we avoid all these pitfalls, right? Let me bring up the presentation. So, what this is. Now, there are many advantages to the foreign exchange business because it gives you access instantly and it is easy to understand and so on. The actual product is not the problem to understand. The actual very nature of man is what you need to master. It all boils down to how you treat your psychological traits. Okay, but we need some help. And the help that the foreign exchange gives us starts with the huge, enormous volumes that it demonstrates on a daily basis. The foreign exchange actually transacts in excess of 5 trillion. Yeah, you heard right. That's 9 zeros after 5. 5 trillion on a daily basis. And when I ask people, which market do you think is bigger? And it springs to mind straight away the New York Stock Exchange, right? That's what we hear every day. The shares, New York Stock Exchange. And I have a graph there to show you that the New York Stock Exchange transacts on a daily basis now with Dow at 26,000 and above that, something around the 100 billion mark. And the foreign exchange is in the 5 trillion mark. So you can appreciate that this gives you a lot of advantages when it comes to operating, right? Huge advantages that you don't have in the shares market or in other types of markets. Right. A thing to bear in mind, this is what we call an over-the-counter market. And the over-the-counter market is a term coined in about 1500 when Jewish merchants were sitting one across the bench, right, or the counter, and they were exchanging money for goods. So over-the-counter comes from this, dates back to these medieval times when the first bank started to be formed. So the over-the-counter business means that there is no central clearing, right? There is no central clearing to guarantee that the two parties will not cheat each other, right? Like the game theory we were discussing. Now, is that dangerous? No, it is not. But I'll tell you what, otherwise no one would be investing in over-the-counter markets. But over-the-counter is that you as a client are taking the counterparty risk. So when it comes to foreign exchange, you have a platform through which you invest in foreign exchange. This platform is being provided by a broker. And this broker is your counterparty for execution as well as settlement. Settlement means that if I buy here and sell there, I made money. I need to be guaranteed 100% that someone will pay my money. This is the settlement process. Now, this is being guaranteed because the broker keeps your money safe on a segregated account. Now, what that means that you send money to the brokerage bank account and they keep it off their balance sheet. So if the brokerage goes bust and nothing happens with your money, right? Because your money sits outside the balance sheet of the broker. And essentially, then obviously there is a process for you to get your money back. But there is no dangers, presumably, when you trade with respectable and reputable brokers where your money sits. Okay, so segregated accounts is what you have to have in mind, that your money sits outside the balance sheet. So the counterparty risk is really, really limited to almost zero, because even if the broker goes down, your money sits separately. Okay, but over-the-counter means there is no central exchange or clearing house. And this was made possible since 2007. So that's only 11 years ago. Because in 2007, Markets in Financial Instruments and Derivatives Directive, what we call MiFID I, came into place. And that was in 2007. And MiFID then said that it is okay for brokers to actually create platforms that are their own platforms, not the exchanges' platforms. And so people will not interact directly with the exchange. They will interact with a broker whose prices are being published on their platform. Now, I don't want to make things too complicated, but generally when you open an account 10 years ago, the only option was to open through a brokerage, but the brokerage didn't have their own platform. You weren't executing against them, you were executing against the exchange. And the exchange was guaranteeing through the settlement or the clearing process that if you made money, you were getting your profits, and if you lost money, you had to pay. Now, this changed with the OTC and MiFID I, because the broker then could create a platform, and then you executed and traded against him and not the exchange. And obviously, the exchange requires the broker to have margin, to be lawful to do this business, right? And so, more or less, this is how, in generally, it works in this business. And you don't only trade foreign exchange on an OTC with a broker, you trade everything. Today's topic is foreign exchange, and we will stick to it. Now, I was talking about the competitive advantages, right, that the foreign exchange has. Now, the competitive advantages, we can see at the top left, there is a very high liquidity, right? Very high liquidity means 5 trillion, you can't really manipulate the market. You say, no one in real control when it says they are downright. You're not in real control because 5 trillion is a lot of money. And 5 trillion, you might have been wondering, 5 trillion is a lot of money. Yeah, it's because of something we call leverage. They're being created, right, not artificially, but leverage, so a form of loan is what is the secret behind this. And we will go through examples for you to understand exactly today what leverage is all about. 24-hour market. This business opens on Sunday evening and closes on Friday evening. So throughout the week, 24 hours a day, you can invest in this business, and we will see why you would actually wonder, why do I need to make a transaction at 3 o'clock in the morning? Right? Because the yen, for example, is very important for the Japanese economy, who trade when you sleep in Europe. Right? But then you would be interested in trading in their own times. So we will take a look at the best times that you actually need to trade foreign exchange. Now, instant full information, because every information that you have about a certain exchange rate is depicted on the price. And we will see again on a different slide what this price is all about. And the competitive stress that I say there down to the left, it's because 5 years ago or 10 years ago, people would be expected to pay at least 3 or 4 times more than they pay today to do their trading in foreign exchange. So competition, and obviously the market being perfected, year in, year out, you actually have the ability to trade on almost interbank costs at very competitive rates and on the same market that the big institutions do trade. And this didn't happen instantly. It happened along the last 10 years, but actually is a very big leap in terms of how people were able to transact in products that, it was a privilege of the banks or the big ones till now. Interesting facts. I mentioned interbank, and interbank market means the market where one bank lends to each other, but also one bank trading foreign exchange with each other, thus creating liquidity. Now, the big banks, they are the market makers. A market maker is simply an entity whose principal role or duty is to provide two-way pricing to you. So when you want to sell, you need to find someone that will be buying. And then when you're going to buy, you need to be finding someone who wants to sell. And this is a job of a market maker. They need to be able to place two-way pricing for you to execute your trades. Okay. Now, interesting enough, the primary market makers who formulate the bid and offer spreads, and I will write right now what the bid offer spread is, are 10 banks. And you can see from that list that these 10 banks are actually 5 US banks and 5 European banks. You got Deutsche Bank, UBS, Citi, RBS, and Barclays from Europe, and Bank of America, Goldman, JP Morgan, Morgan Stanley, and HSBC. 73% of the total FX volume is traded through these 10 banks. And that's big. Right? So that gives you an idea of how difficult for you is to be stepping into a market without having the right knowledge to do so. Now, the maybe 25.51 to 125.53, this is the price of euro dollar. Right? What it means? It means that buying €1, you financing with $1.25. Right? So, for this says, how much can you buy this currency to the left by financing it with this currency to the right? Yeah? That's what it means. That's the foreign exchange actually entails two transactions. One is that when you say I buy euro dollar, it's not one product that you buy. You are buying euros against selling dollars. Think about it, the same thing like with Apple, right? I think this is the symbol on the stock exchange. You buy Apple, you actually pay dollars to by Apple, right? So you could think that this is also a foreign exchange pair, because it says how much of these you can buy by using how much of these. So I said the same thing here. 1 euro buys $1.25. Okay, so hopefully this is clear. We will mention it again several times today. And the importance of this is, and let's see just one bit of terminology, is the bid-ask spread. Now, when I was saying competitive spreads below, that's what I was meaning. That 1.2551 to 1.2553, these are just 2 points, right? This is the spread. This is the difference you are paying and nothing else. And this is called bid-ask spread. Now, the important thing is that when you want to sell, these are the buyers, right? Bid is buy, and ask is sell. And so, bid-ask spread means what you're buying. So if you wanted to sell right now, you wouldn't be putting an order here, because this will put you in a row with others, right? In a queue, I'm sorry. But if you wanted to sell, you would be selling at this price, because this is the first available buyer. So if you wanted to sell, you sell here directly, and if you wanted immediately to buy, the only price, the best price available for you to buy is this selling price. Yeah? Again, if you wanted immediately to sell, that would be the price. If you wanted immediately to buy, that would be the price. And so bid-ask spread is the difference between where you're buying and where you're selling. Yeah? But it's very important to keep in mind, again, once more, that this is a currency, and currencies are traded in pairs. We will see it now. When you buy 1 euro, it means that you are actually automatically selling $1.25 to finance your 1 euro purchase. Okay? I hope it is clear, and we will go through again. Now, we talk about, finding out what the market is and so on, but when you actually trade, all you need to do is manage one simple trade. Right? There are two types of trading. And as I said, psychology and risk management is really the key. Foreign exchange, you will learn. Right? There are a few pairs, few rules behind it, you will learn. But then how to make money out of it is actually trying to fight your inner ego, because that's what you're trying to fight. Keynes, and I usually say that this fantastic economist back 100 years ago, he said that the stock market business is a metaphor to a beauty contest. So in a beauty contest, you don't try to anticipate who's the prettiest girl, which one. You're trying to anticipate what your colleagues are trying to anticipate and think what or which one is the prettiest. So this is the same in the stock market or in the business in general. I don't know where the euro dollar will be going, but I would try to think what you think it will be going. And that's the essence of the business, right? And do yourselves a favor and buy a book that has no mathematical formulas in there, and yet describes, in the best way ever, in my opinion, what this business is. I will give you a powerful insight of how to be able to participate in this lucrative yet, risk management worthy business. And I'm talking about a book called The Reminiscences of a Stock Operator. Right? Excuse my handwriting. Now, this is a book about one of the world's famous traders. It was called Jesse Livermore. Yeah. And the author of the book is being presented as one Edwin Lefebvre, which we presume is a nickname. We think that the guy wrote his autobiography. And Reminiscences of a Stock Operator is a cheap book, $15, paperback. Do yourselves a favor and buy it, and it will give you so much insight on everything that other books with so many thousands formulas won't do for you. Right? This is a number business, but it is a business that actually has to do a lot with psychology. And there is, so much important is psychology, so important for this business that there is a branch of, or an offspring of economic studies called behavioral finance. They study the reaction of the human brain to actually try to decipher, right, your reactions in terms of buying or selling decisions. But this is another story. But definitely all these human characteristics that you have, studied from your own ego, are your first enemy and no one else. Okay? So this book is talking about how this guy got rich 3 times and got poor 4 times, so hopefully vice versa. It's not clear in the book. But what it is clear is that the guy tried to read the tape. He was reading the numbers and then trying to understand exactly this, the human psychology going against the crowd. Because you should be aware that we human beings, we don't like to be acting alone and separately from the herd. We actually want to be in the herd. Okay, if someone buys, I want to be buying. Not because I know, but because he is buying, and I don't want to be left out of the game in case this or the stuff that he's buying is going up. Right? Like the Bitcoin frenzy lately. So there is no rationality. I've got news for you. Human beings are completely irrational human beings. Right? We are irrational. We don't act based on rationality. And that's not obviously what the books teaches so many years. So that book is, to close this parenthesis, is showing you exactly how you overcome these things through examples. Now, as I said before, there are 2 things or 2 styles that you would be trading with. One is the style where you would be making many small movements with, small profits, +1, +2, maybe -1, +4, and then comes big loss, -12, and then +2, +1. This is a range trading, right? The range trading. So euro-dollar goes like this. Every time it touches here, you buy. Every time it goes there, you sell. Touches here, buy. Goes here, sell. And so on. And at some point, this goes here, you buy, and falls and produces your -12. This is the only trade that you need to actually risk manage. Right? The rest is your capacity to make money, small trades all the time, trading within the range, but the breakout, as we call it, is what you need to manage. And this is where the risk management comes into place. On the other hand, there are other people who actually lose money a lot of times, but small quantities. -1, -3, -2, and boom, +10, and then -1, -3, right? So this guy here is trying to capture the trend. So when a market goes like this, and is choppy, as we say, and then starts a trend. So you are trying to make money, buy here, sell here, buy here, sell here, buy here, sell here. Eventually you lose this money. And when you try to buy and then not really care about these small fluctuations here, you might be losing sometimes. Eventually you want to catch up this breakout. Right? This is the trade you need to manage. And all of these things about technical analysis and indices and oscillators, and I don't know if you have heard the moving average, MACD oscillator, John Bollinger, who by the way did a seminar with us and for us in the Money Show in London 3 years ago. I don't believe he's using his own indicator anyway, but you can see screen after screen after screen with many, many indicators and people trying to explain to you that I'm drawing this and I'm trying to make a shape that will help me determine the future, etc. Yeah. If you can't explain your strategy to your 6-year-old, then your strategy is worthless. You have to be able to talk to your daughter or son, your 6-year son or daughter tomorrow, right? Or your nephew son or your nephews, and tell him, listen, when I buy and goes up, I make money. And when I sell and goes down, I also make money. And if I happen to do it the other way around, I lose money. Serious. Okay, that sounds simple. But if you start talking about this is a channel and we have an oscillator that will give me X percentage of certainty if it goes up, and when it goes here, I start forming, I won't even bother you with this. You have to be able to explain it to your 6-year-old. Bear that in mind every time, because remember, human mind can absorb a maximum of 18% of information that it listens in a webinar like this. So 80% of what we will talk today is what you will remember at the end of it, right? So you will actually be tempted to draw these lines and make formations, etc. But always remember, first, talk to your 6-year-old. Okay? So, when trading FX, the dealing prices quoted to you are directly correlated to those prevailing in the interbank market. What does it mean? As I said before, you are actually trading on the same prices pretty much that the banks trade with each other. And this is fantastic news. Right? Since the mid-90s, with the advent of online foreign exchange trading on margin, clients can now trade from their own home. Margin is the key word here. Margin and leverage go hand in hand. So this is a business where you're only required to place a small amount of money of your capital and participate as if it was a very, very big amount of money. And this is completely legal, and brokers and exchanges allow you to do it, and it's very, very good strategy, but you also have to be very careful how to use it. And we will see an example why it can hurt your capital, remembering that your capital is your lifeblood. Right? So you can't go on without capital in the exchanges. This is a marathon we are talking about today. It's not a sprint. Seminar after webinar, people come to me and say, listen, I should have done what you told me because I heard you, it was okay, and then I put 5,000 and I blew the account. I tried to take excessive risk and I thought I could make on a good move some extra money, and in just 4 days or 1 week, he falls into the 90-90-90 rule. Yeah? Why? Again, because he is a human being, right? But some of it goes, it has to go automatic. Like you play tennis. You don't think every single position, where your feet goes, where your hand goes, how much you open, how spin you get. No, it comes automatic. And how does it come automatically? By training, by experience. You have to be experienced, and to do that, you start with a small account, you put very little money, and you think of it as a training. You don't want to make money. For you to make money, first you have to learn how to lose money. I don't know if it sounds peculiar, but that's how it should be. You have to learn how to lose money before you start making money. Okay, so since the technology gives you access to unparalleled functionalities of the platform you're using, since you're dealing at the same prices with the big guys, and since you also have privileged information, then you should be able to do well. But no, it doesn't stop there. You have to invest in your education all the time, because people are constantly ahead of you, waiting for you as the small fish. And the small fish would be exactly the opposite from what we are saying today. Would go in with 3,000 euros, will take 3 bets, and then they would lose it all, and then a negative spiral goes or comes into play. Think about the casino that you are going, right? You go to the casino, the majority of people will actually entail into a martingale scheme, right? And what that is that the pyramiding of losing positions. So when you go to the casino, you place 20 euro bet, and then you lose that. And then what you do next? You place a 40 euro bet, right? And then you lose that as well. And then an 80 euro bet to break even with your losses, then 160, 320, 640, 1,280, and it goes all the way until presumably you have the deepest pockets in the world, and all the time in the world, what is the best, and I repeat, what is the best outcome that you would expect in this situation? It's your initial bet. You are actually trying to make back only the 20 euros by taking so excessive risks, but you don't realize in the process. So people, when they buy euro dollar 122 and it falls, they buy again 121, 120, 190. Why? If you bought something in the first place and went down, it's obviously wrong. Why financing something when it is wrong? I'll tell you why. Because of your ego. Because our human minds, right, are not trained to be able to punish you, to punish yourselves. You can't punish yourself, right? At least, obviously, it's not as easy. So your mind and your psychology will find shrewd ways to try to avoid that or postpone it or put it under the carpet. And so the process would be, hey, I bought a 122, it fell. Well, listen, but maybe I wasn't right. Maybe the decision I had at the beginning was not made, under a good analysis. And then it keeps falling and falling, and so we will see how the human psychology then gets into place in that. But what you have to bear in mind is that you always need to have a trade with a positive expected return. This, right, should not be the minus 0.27 that is the expected value of your investment when you trade on that casino example. If you trade by increasing your positions, what we call moyenne in this business, increasing stakes and losing positions, you are actually betting, not investing. And there is a serious and a huge difference between gambling and investing, or what we call speculating. We are speculators. We are not gamblers, and we don't want to be in the 90-90-90 rule. I'll see you in 2 minutes. Get a glass of fresh water, and we'll be back in exactly 5 minutes. Yeah? Let's make it 5 minutes. Thank you very much. Don't go away. Hello, welcome back again. So where we left it is the process of where you capitalize on your losses and then you actually increase a losing position, which actually doesn't seem a very rational behavior, right? For those of you who actually have some sound problems, we do these webinars every week, so you have the opportunity to watch it again and again. The Facebook is the most widespread platform for live streaming videos, and hopefully you have very, very few connection problems. But maybe log in and log back, and you don't have any issues. But I've only seen a couple of comments there from these 5 minutes. Right, so before going to the major participants, I wanted to tell you that there was a survey in Taiwan, right? And a Taiwan, exotic country, some people might say, but this is the biggest survey that has ever been done on people's performance when they trade the markets in a certain way. And that was between 1996 and 2012, so not very old, really. So within these 16 years or 15 years of sample, some 400,000 traders, and even 420, I think was the exact sample, took part in a survey that measured their performance, right? And they were doing intraday trading, so they were buying in the morning and selling throughout the day, and they were dealing mid or medium-term investing or trading, so maybe keeping a few months, and in excess of 1 year. And I think the results are astonishing. They are astonishing because they show that the percentage of traders losing their money without the proper knowledge across a sample of almost 500,000 for 16 years in the markets is 98.3%. 98.3% of the people who trade on an intraday basis lose their money, right, very, very quickly, and only 1.7% actually manages to make some money. And yet, people have the superpower, they think, to actually win in these markets by doing many transactions. And all it takes is a little bit of history and statistics to just understand where you're getting into. Now, I'm not trying to intimidate you because I'm loving it. I do it every day. I live off of that, among other things, like the magazine, The Right Run, and like managing other people's money, or performing webinars, seminars on options and futures, and other asset classes as well, and technical analysis. But we do live off of it. So it's not nuclear science that other people understand and do it. But we really have to appreciate that we need to approach this as, what's the word? We need to be, not to show off, I would say, right? I can't find the right word now. But we can't be showing off and pretending to be the best, right? We need to be humble. That's the word I was looking. Right? Being humble in this business, understanding that you are no one, you know nothing, helps you get and go very, very far. Trust me. Right? Humble is the key. So the result going away from the intraday into the couple of months, like holding position for a couple of months, so you increase the amount of time that you hold the positions, that increases the percentage of people who actually made money within a certain period of time to about 7%. That's a huge leap. And then people in excess of 10% and around there are people who are actually investing long-term. Now, the foreign exchange business is not for long-term investing, right? You have the leverage and you try to appreciate and take advantage of small increments of a price increase or price fall. But bearing in mind that among a sample of 500,000, 1.7% actually make it consistently, you have to do a lot of work. You have to study a lot through experience in the markets, right, to be able to make it. Okay, you don't want to lose your money like, hey, I've got 5,000, let me just invest, and then hopefully I can make my payment next month. I can pay the water bill or anything like that, or my daughter's tuition. Never do that. Never do that. Only trade money that actually is spare. Right? Never try the stock market or the FX market to pay for your needs. Never, ever. It doesn't work. Trust me. So this is an interesting fact that hopefully you can bear in mind when you start trading with this. The major participants in foreign exchange market are these big guys that you see there. Now, imagine that the 5 trillion is being executed by these big guys, which are banks. There are big funds like Amundi, BlackRock, PIMCO, and Templeton. All the big guys that manage billions and billions of dollars. And they can execute trades and they can form certain irregularities within the normal trading sessions. Corporations, very important, and importers, exporters. Why? Because they set the tone for the market. Now, the real economy will set the tone for what you will see happening in the exchange. And so there is a report actually called Commitment of Traders. So the COT report, as we call it, and it shows the net positions, long or short, of the big commitment of traders. It will show you the positions of the big traders, the big commercials, right? Because in this business, not everything is speculation. There are people who actually try to hedge, try to protect their wealth. So if I'm a producer and I'm worried about the weather 3 months down the line, I will come to you and tell you, hey, listen, do you want to take a bet? I'll give you $100,000 to secure my crops. Right? If something happens to my crop or my oil production or anything, you will have to pay me, just like an insurance premium. Right? That's what it is all about. This is how it all started. And there are some people who actually only take insurance premiums. They don't care about making money. They care about protecting their harvest. Okay? And these are the real economy. And the COT, the Commitment of Traders, really shows you, many, many things about how the market will perform. Okay? So, very important to keep a close eye on them. Now, the most traded currencies, because there are roughly 150 currencies in this world. The most traded ones are the ones you see on the screen, so the dollar, the euro, the yen. You would expect them to be the currencies of the major economies in the world. Okay? And as I said before, the foreign exchange or any currency is being quoted two-way. Yeah? So you buy one currency against another. And let's see an example of what it actually means. Now, this currency to the left, remember it, is called base currency. And this currency to the right is called secondary currency. Why they're important? Because you always buy an exchange rate, right, in reference to the currency to the left. So when you buy euro-dollar or euro against dollar, it means that you are buying euros and simultaneously selling dollars. When you are selling euro-dollar, it means that you are selling euros and you are buying dollars. Because you can actually sell something when you expect it to depreciate, to fall in value. Yeah? You don't have to own beforehand something to be able to sell it. You can sell it without having previously bought it. And this is what we call the short selling. Yeah? So this is a huge difference than the equities market, where the only way to make money is by going long, as we say. So that's one more word that you actually need to know, that long means buy and short means sell without having previously bought. Okay, I go short on the market means I see the euro-dollar here, for example, 122.50, and I believe it will go down. So I short the euro-dollar. And where will the euro-dollar I expect it to go if I think it will go down? Well, will it go to 123.50? What does it mean? Think about it logically. Don't try to memorize it. If 1 euro, so 1 euro gets $1.22 of the dollar, then 1 euro gets $1.23 of the dollar. So it takes a little bit more dollars. That means that the dollar lost value, right? You can take more dollars for the same euros. The dollar has lost value. In other words, the euro has appreciated. Again, if I need $1.22 and now I need $1.23 to get 1 euro, then the dollar has fallen. And consecutively, the euro has gone up. It has appreciated. If I'm short, I lose money. Because being short means that I expect the first currency here to the right. Yeah, we always reference it to the first kind, the base currency. I expect it to fall. So that needs to go to, for example, 1.2050. Yeah? So 1 euro takes $1.20, right? So the dollar has gone up. So I was short euros, the dollar has gone up, means the euro has fallen, so I make money. Yeah, I did it deliberately the other way around to make it more difficult, because you need to understand, I don't care if it goes up or if it goes down. I only care, right, to be on the correct side. So I can bet, well, I can speculate that the euro will fall. That means that the dollar will go up. That's the essence you need to understand here. And how does the dollar appreciate or goes up? Well, if I give less dollars for 1 euro, that means that the dollar is actually getting stronger, meaning that the euro is getting weaker. And because I was short the euro, I made money. Okay? Now, presumably we got that. We are ready to see how leverage plays a role in it. And I will go through this. So this is an example of some rates. This is what I just explained. This is an example of the sterling against the dollar. So 1 sterling, the currency to the left, takes $1.50, which is exactly the same example that we did on the euro dollar. Yeah? Flicking through the presentation, base currency, it's quoted first, so it's the currency to the left, just like the euro against the dollar. In this case, is the pound sterling, right? So the currency to the right is the secondary currency. Yeah? Or you might find it as term or quote currency, it doesn't really matter. You just know that it is a secondary currency. And the cross currency is a pair of currencies where dollar is not in the equation. Now, this is the bid-offer spread, and this is the last slide, then we can see the example. The bid-offer spread we discussed before, right? You can see 136.38, 136.40. This is a spread, and then we will see how does this spread translate into making money, right? Or losing money. Okay, but the spread is what you're paying, what we saw before, the bid-ask spread. The price to the right is the price of the buyers where you can sell, and the price to the right is the price of the sellers from which you can buy. And consecutively, the price to the left is the price of the buyers to which you can sell. Now, before I go to explaining the leverage, I just need you to take a look at one more slide, that is the swap. Now, the swap is what you would be expected to pay because, or receive, because you are trading one currency against another, right? So when you are buying euros, you are effectively selling dollars, as we said. And now, if euro has a high level of interest rates, so say 1%, and the dollar has a level of lower interest rates, say 0.5%, effectively you are buying euros, so it's as if you would put them in the bank and you make money because the bank pays you 1% interest. And selling dollars is that you borrow dollars and then you pay the bank 0.5%. You make one, you pay half, the difference is positive. So when you are long euro dollar and euro's interest rate is higher than the dollars, you would make money on overnight position. If you buy today and sell it tomorrow or the day after, every single day will be calculated on something that we call Tom Next rate. Every single day, the swap rate will be calculated. You will receive a swap rate, it says here it is positive. You will receive it if you are going long a currency that has a high interest rate compared to the one you're going short, and you would be expected to pay if you are short the currency with a high interest rate level. Okay, because you are borrowing at a higher cost than which you are lending. All right. Now, not really so important, but definitely you need to bear it in mind, because the swap rate is a cost for those who hold the positions a little bit longer. Now, this is interesting, as I said. The foreign exchange market starts at 9, let me go back to that slide. Oh, it won't let me now. It starts at 9 p.m. on Sunday and closes on a Friday evening. Yeah, but the important thing is this slide here. You should be confronting trading as a business. The same way you're putting your money into anything you do in your life, you buy a car, you buy a house, you go to a restaurant, you pay for gasoline, and you think about it, the same way is when you actually invest in the business of exchanges, in this case a foreign exchange. You have to have a plan, and you have to be obedient, and you are a soldier, as we say. Right? So you are respecting and following some rules. You want, as we said before, a positive expecting result. Right? A positive expected return. You don't want to be a negative. And the way to doing a positive expected return or having is to make a plan, a very detailed plan before you start, and putting it into practice and respecting it. And the way you can do that is by following some of the rules. That, and you should not be surprised, might include meditating, for example. Some people find it increasingly useful to meditate because that takes all the noise away from them. But you don't have to trade all day long. This is the good thing. When you start trading the foreign exchange, because it's a 24-hour market and because there is a huge liquidity with all these advantages, the traders that you are against, the banks, the corporations, the big funds, they have certain habits. So they go on holidays in August. You go on holiday in August when they go on holidays. You don't trade in August. Simple as that. You go on holidays. They take holidays Easter. They take holidays at Christmas. And they don't work weekends. Never. So this is a profession, ultimately, that can help you achieve what you want in your life by treating yourself as a professional investor or trader into this foreign exchange market. You will be able to work, yes, you work hard, right? But you have your own time to actually do that. And you don't really need to be in front of the screen 16 hours a day, because this, you're doing it to liberate you from what you're doing now. This should be liberating, not to put you under a stressful situation and make you a slave of your own choices. No, if you want that, you maybe have a business with some bosses that actually, you would prefer to be your own boss in your business. So you don't leave one business where you have many, many managers and hopefully, you're doing all right, but, maybe it's not the best of the outcomes that you wanted for your life, and go to this foreign exchange business and be worse, because you sit in front of the computer like 16 hours a day, you stop talking to your friends, you start having stress. No, this should be fun. Really, this should be fun. And it should be liberating, right? You always have to have that in mind. And when it stops being that, these two main attributes, is because you start gambling. And you start gambling when you don't have a plan, right? And when you actually sit to start trading, you pick a time in the day, and that's what this slide shows here. You try to trade when the markets overlap. You try to trade when Asia markets close and then European markets open at about 7 o'clock GMT time, or maybe slightly earlier, right? 6 o'clock. And then you try to trade when European markets are towards their closing, but then the US markets are opening, and that happens 2:30 UK time, yeah? And then you would maybe try to trade when the US markets are closing and the Asian session is opening towards 8:30 in the evening UK time. You don't have to trade all day long. The market is here today. The market will be here tomorrow, I can guarantee, and it will be here 3 days after. What you need to do is have your capital preservation in mind and think of it as a marathon. So you want to make little things every day that will add up on your portfolio and your experience rather than hitting the jackpot. Because you cannot do that, at least consistently, because then you would be gambling. And we are not gamblers today here. We are speculators. If you want to gamble, you can still go to the casino. You have free food and drinks, and maybe you can do it once in a while if you want. But this, it's not a casino. And so never treat it like that. Okay, so the actual time slots that you can trade is really up to you. You can trade in the morning 2 hours, but that doesn't mean during the day you won't do anything. You have to study. You have to, keep up with the news, see what other people are talking around in the market, but not being affected. Because as I said, the human behavior moves in tandem, moves in herds. The herd behavior is not something that you want to adopt in this. You want to be able to make your own decisions, and the only way to do that is being informed. So if you trade 2 hours in the morning, there are certain rules you should follow. The 2 hours, the session stops. So if you made money, you close the session. If you lost money, you close the session. And if nothing happened within 2 hours, you close the session. There is no reason for you to keep positions open or be afraid of losing money. Don't be afraid of losing money, because that is part of the game. What you should be afraid of is not to having the correct risk management, which we won't be able to have time today to go through it. We can talk about it in some other webinar, and you can chat me on Facebook or email me through my webpage. And the risk management is key. You know how many times the richest, the best traders in the world, the Larry Williams, the George Soros, the Mark Mobius, Joe Ross, John Bollinger, Ralph Acampora, you name it. I don't know if you recognize any of these names, but they are the biggest traders around there. Do you know how many times they get it right? 4 to 6. And some people answer like 9. I mean, they are the best in the world. They should be getting it right all the time, right? No. They get it wrong by about half of the times. What makes the difference is that the half of the times they make money, they manage the position well. They don't cut their losses very late, and certainly they don't cut their profits very quickly. And so the risk management, how you manage your position and your money, really makes a difference. It's not about losing the money. And another statistic that will help you understand is that the ego, your ego, when you start to trade, will tell you, listen, I want to be able to tell my friend that I bought at the lowest point and I sold at the highest point. And that's what you want to do. And then you gamble, right? You want to tell your friend I bought at 220 and sold at 260, and that is the high and the low of that day of that particular instrument. No, it doesn't matter. Entry price, right? Entry price accounts for about 15% of your trade's success. So don't try to guess where you will buy or short something. Try to be prudent in how much money you put in there, and we will talk about it now, and what happens if it goes wrong, because that's what it will make the difference at the end of the day. I gave you an example before, like when someone buys here, right? Buy, goes long. Excuse my constipation. I can't help it. Right? The buying here, you have to be beforehand definite about where you will go out, whether you win or whether you lose. And when you lose, we call it a stop loss, right? When you stop your losses. When you open a position, you should be able to make about relationship 1 to 3. Remember at the graph at the beginning, I spoke about the gold surge in 1973. The relationship was 1 to 25. But 1 to 3 should be okay. So you want to make 3 times more than what you want to lose. So if you are going for $100 make or gain, you can't afford to lose more than 30. And that's your stop loss. But then ego comes into place and the lack of the ability of yourself to punish yourself. And when you buy here, you don't respect that simple rule because it's okay to be wrong. I bought it, it fell, I go out, forget about it. There are millions of trades that I will do again. I can't really stack on that mistake of mine. So you have to go above and beyond that thing. Right? And it falls. And then suddenly you say, oops, I think I was exaggerating with putting my stop loss at $30. As Ioannis said, listen, well, there is time to actually cancel it. You cancel the stop here, so you would have lost just $30 and then go in again. But no, you cancel it. And you think the market will go up. This is just a short-term fluctuation. And surprisingly so, the market continues to fall. And then at this stage you say, you start worrying, right? And then you say, well, I possibly didn't have the correct judgment at the beginning, but maybe now we can buy a little bit more. And then you do that deadly mistake of buying and scaling on a losing position. And then you buy a little bit more. And then surprisingly enough, this continues to fall because bear in mind that the markets actually go up on a staircase and fall or on an elevator. They go up very, very slowly because when they start going up, people think, I don't know, this doesn't seem like a good market to be in. And then more and more people buy, and then you say, well, it will start falling. And then more and more people buy, and they say, oh, well, maybe this is a good investment, actually. And then instead of buying here, you actually enter here at the top where the real bubble is being created. And when the bubble is created, everyone is pushing his fellow to go out of the door. Because when actually things start to get bad, people engage a herd behavior. And then they want to go out. And with the same irrationality that they bought, they now want to sell. And so everything will actually succumb to the gravity. It will fall much faster than it took it to go up. In a very short period of time, it will fall much faster. So this is how exchanges are. I'm sorry to tell you, but that's how it is. At least someone tells you. I normally start on my webinars. I didn't do it today, but I normally started with this Matrix. You've seen Matrix, the movie with Keanu Reeves? And at some point it offers the guys there 2 pills, one blue and one red. And they say, listen, if you want to take the red pill, right, you can stay in your imaginary world and think that everything is fine and believe everything they tell you and, live in your world. I don't have a problem. But if you take the blue pill, we're going to talk about truths. And that's what we've taken today. We took the blue pill. And we took the blue pill because you're here today to find out how easy it is not. Okay? But it is very, very lucrative. But you have to be careful how to use it. So going back to the example, this continues to fall, and another set of deadly mistake takes place by putting the last drop of your money here. Because you say, listen, it cannot fall more. It can't be that I bought here and fall there. And you bought here. Why? This is your anchoring effect. Anchoring effect means that you actually think that because the price fluctuated here in the past, then it should be around these levels, anchoring. I think the past prices will actually show me exactly what the future will do. No, past prices are okay to show you how future market will move, but it possibly rhymes. Yeah, it doesn't follow the same pattern, but it rhymes, as we say. But that doesn't mean that the price that you saw in the past is a reference point, but we take it as a reference point. And instead of avoiding all this pressure, all this self-punishing process, all this losing money vicious circle, by respecting a single rule, very easy, don't ever in your life move the stop loss. There was a reason why you put it there at the beginning. Instead of doing that, you actually fall prey of your own emotions. And then lastly, here, it continued to fall. And then here you say, guys, I was wrong. I was wrong. It can't be. But how couldn't I see it? I'm wrong. Sell it all. Cash. And then you sell it all. And you know where the market bottoms down? Exactly where you saw. It's as if the market was waiting for you to actually sell everything. And then the market starts going up. And it will eventually go up. That's even worse. How many times you will be caught up in a situation like this? Thousands. If you don't respect that single rule. When you buy something and goes up, you were right. You bought something, it went up. How easy it can be. I can explain it to my 6-year-old, remember? If I buy something and fall, something was wrong. Kill it. Kill it. Don't try to fit it. Kill it. There's another trade waiting for you. Okay? No. What the behavioral finance teaches us, right, is that humans' mentality is being split into two compartments. One is the emotional, the other is the logical, as you know. And several of these compartments, each one is responsible for the decisions you're making. It's like, the gasoline example that I give. You go to a gas station, which is like 1 kilometer of your home, and it's 150 the gasoline. But no, you know another one which actually sells for 148 the gasoline, but it happens to be 10 kilometers away. Let alone the gasoline you spend to go to that other gas station, which actually makes you spend the 2 cents you make. You are going to that other one not because you want to save the 2 cents, but because you want to be able to tell your friends and yourself first and foremost that you are proud you have found the cheapest gasoline. That's why. Does it make sense? It doesn't. And it doesn't make a difference, to be honest. So, maybe next time you think wisely and actually follow this simple set of rules. It's not easy. Write it down. Put it in front of your computer and say, I will never in my life do this and this and that. And then with experience and with training, it will come and it will be an automatic decision. That's what makes big traders separates the wheat from the chaff, from the small traders who lose their money in 90 days. It's simple, isn't it? Yeah, it's simple, but you have to fight yourself to be able to achieve it. But it's simple, it's doable. It is doable. People have done it. So you have to change your mentality towards what you have thought so far is the actual exchange. Okay? This is about the time zones that we saw before, and these are some announcements that actually reflect how the foreign exchange will move. But what I want to give you now is I will change the PowerPoint because I want to show you how leverage works before this seminar finishes, right? And yeah, so just going a quick recap to tell you that we're going to now see the value of a pip you know what a pip is, and how, well, avoiding the common mistakes, we've covered it pretty much. The value of a pip, long versus short, as we said, is easy to go both directions, and basically how to use the margin. So, recapping, you've got a market which is 24 hours, unlimited liquidity, the 4 to 5 trillion, going long or short, no problem. You can do it based on, you know, where you think the market is heading. Easy to understand, is only a spread, you know, the bid-ask spread that you actually need to understand. No commissions, tight spreads, yeah? And the use of leverage that actually helps you use a small initial capital to participate in this OTC market. To the right, I've given you some symbols of the big currencies and the volume that we discussed at the beginning. This is just a recapping, that's why I'm going through the slide, right? That the difference is, and this is already outdated, from 100 billion of the New York Stock Exchange to the 5 trillion on the foreign exchange. Currencies are quoted in pairs, such as the euro versus the dollar, and one currency increases in value, it does so in relation to the other currency, which decreases in value. And what we didn't see is that from the dollar-traded currencies, the euro against the dollar actually accounts for 86% of all dollar trades. Yeah? So 86 is within the euro-dollar. And the important thing here, currencies are traded in decimals, which are called pips, price in points. Let's see how the anatomy of a trade now is being used. Right? So, on the example, euro against dollar at 122.50, and I said this is the base currency, the euro, and this is the reference currency, the dollar. And I was insisting on that because now that you're going to trade, we're going to see the anatomy of the trade using leverage, the margin, the amount of money that we will put, that very small initial capital, will be in terms of that currency to the left, whereas how much money we make, the pips, will be in terms of that currency. So, this is a business where we say we're buying in lots. So we say I buy one lot or two lots or even a mini lot, which are, you know, smaller increments of that. But say one lot is that we buy. This is always equal to 100,000 units of what? Of the currency to the left. In this case, euro. If it was dollar yen, it would be dollars. That's 100,000 euros. This is one lot. And respectively, that would be translated into $122,500, right? That's the same thing if I take the rate. Now, how much is a contract? Well, I multiply, 100,000 by 1, this is $122,000. Yeah? And I deposit 1%, because what it says here is that leverage, because that's what it means, leverage here on the slide can be expressed in ratio or in percent, as you see the table. The leverage is a loan, nothing else. Yeah? So when brokers allow you to trade on a leverage basis, they allow you to trade on a loan. So 1%, it's 1 over 100. So 100 times leverage is equal to 1%. So if that thing costs $122,000 or 100,000 euros, I will be called to deposit only 1%. 1% of 100,000 euros is 1,000 euros. Or, to make it easier, $1,222. So that, my margin, as we say, is $1,220. I'm sorry. Yeah, or 1,000 euros, as I say, because the margin is always equated to the currency of the left. But Say this thing goes to 122.72, right? This in the euro dollar is expressed in 4 decimals. The euro dollar will always have 4 decimals, right? In other currencies, it's not like that. In dollar yen, for example, you would have 2 decimals. We will see the example today if we have time. But in euro dollar, it's 4 decimals. So the 4th decimal is the pip value. And every pip for every 100,000 units costs $10. How do I know that? You just multiply 100,000 by the amount of decimals. 4 decimals multiplied by 100,000. That actually gives you $10. Always the pip value is related to the second currency. So, for one lot, which is always 100,000 units, which is based off the base currency, that to the left, yeah, I deposit 1,000 euros or $1,200, which is the same, yeah, and I know that every point, so 122.50 to 122.51, I made or lost $10. And you can make a smaller position. Instead of 100,000, you can make a 10,000 position, which we call it a mini lot. And then the pip movement will be $1. Let's take what average trader is doing. And one lot simply wants or requires from you $1,200. It's an amount of money that most people can deposit. And then they will know that every pip will be worth $10. Now, this has gone up by how many pips? Let me erase that. It has gone out by 22 pips. So 22 pips by $10, right? Every pip is worth $10. We made 22. That's $220. And that's the beauty of leverage. $220. How much did you deposit at the beginning? 1,200. How much is 220 in 1,200? Is about 17%, right? 17% with just how much of a movement in the actual exchange rate? And you can tell me that very fast. 0.17. Why? How do I know that? Because you took a 1 to 100 loan. 1%. So all the results here are magnified by 100 times in your account. So all it takes to double your account is how much? 1% for that euro dollar to move. And they do move 1% quite often. But the same stands for you to lose all your account size in just 1% movement. And that is why I tend to give an example of the Ferrari. If I give you a Ferrari and just try driving it 300 kilometers per hour in the middle of the center of the city, you will eventually crash. Whose problem is that? It's not the Ferrari's. It's yours. It's how you drove it. And that's why the leverage can be a cushion and a double sword. So you can make a lot of money, but you can also lose a lot of money. And that's where the risk management principles get into place. Yeah? So, recapping, the use of leverage is the key in this business. It allows you to put a small initial capital and participate in a big, as if you had a big capital. The normal leverage is 1 to 100. So you only put 1% of that position, as we said. You put $1,200. The exchange rate, in this case, you bought euro dollar. And because the euro dollar went from 122.50 to 122.70, it went up. Because now you need slightly more dollars to take the same euro. So the dollar has fallen. The euro has gone up consecutively. So you made money. You made 22 pips. And how much was a pip worth, as we said? For every 100,000 units, the pip is worth $10. So So you made $222, and that's compared to the amount of accounts that you open, $1,200, that's 17% return on capital. Okay. If you were to trade, for example, dollar versus yen, right? What would you do? Dollar versus yen might have a price which is like that. $1 versus yen. $1 will buy 110 Japanese yen. $1 of this is getting bought by how much of this? Yeah, as we said, the example with Apple. And how do you do the pip value? Well, 100,000 units multiplied by how many decimals now? We got 2, not 4, 2. And that will give you a value of 1,000. 1,000 what? We always said that the profit or loss is always related to the second currency. This is 1,000 yens. So to make it into dollars, you just divide by this, the exchange rate, and you get about $8.78. That's the pip value on a dollar yen. Now, you have to make this exercise quite a few times, obviously, to get acquainted with, but you realize the power of leverage. That's what I wanted to show you. Remember that the margin is being based on the left-hand side currency, the profit and loss on the right-hand side currency. This is a profitable business, but you need to be aware of how you drive your Ferrari. And flicking through the rest of the slides, this is again the same example. Going short or long is just as easy. This is an example like the one I just did. And example on gold that we can see some other time. We don't have time today. We're running out of time. I'm sorry. The 4 things to bear in mind. Choose the correct contra side. Will it be in 1 lot? Will it be 2 lots? So 100,000 or 200,000? How much money do I have? A rule of thumb is that you only put 2% of each position. 2% of your total. If you have $3,000, you will put $60 in a position. And people tell me, well, how can I make money out of it? Well, you can't make money with $3,000. No. And that's the mistake. Small accounts, people who start and put 3,000 small accounts, they get depleted because they try to make, in a get-rich-quick scheme. No, it doesn't work like that. The $3,000 is for you to learn how to do it. Education, again, education is the key. And then growing your account, and growing your knowledge, then obviously you can start building confidence and making some decent money. Entry point, I remind you, only 15% accounts for your entry point success. Target price, where will I go out? And the stop loss. And I wanted to close with these words here. This is the Chinese symbol for risk. Now, in a Webster's dictionary, the risk is viewed as something negative. Yeah, risk is being considered as danger. Now, the Chinese have been clever enough to actually say, no, risk is actually a symbol that it has 2 components. One is danger, and the other is opportunity. So you will actually make more money by taking up more risk. And that's what risk is. Risk is good. Risk is not danger in its own right. Risk goes with opportunity. The higher return you expect, the higher the risk you should take. And I believe that sums it up for your trading philosophy. Last but not least, remember, if you are not willing to learn, no one can help you. But if you are determined to learn, no one can stop you. Thank you very much for attending today. Hope you have enjoyed the webinar. We'll be here next week as well. We have a Spanish webinar on Thursday in 2 days, same time. Log in if you like. You will receive an invitation. And I'm free to answer your comments on that Facebook page or on my web page, which I remind you is the one here. So if you speak Spanish, my magazine traders-mag.es. Let me just play. Yeah, Kantartzis.com is my personal website. You can take a look at my CV and the things that I've done, and you know how we can help you more on that. Facebook Traders España, and the email info@ikantartzis.com. It's been a pleasure to share these 2 hours webinar with you. Thank you so much again. I'll see you soon. Thank you very much. Good night, everyone.